Large cap stocks remain a favorite amongst investors, especially during times of uncertainty, when risk tolerance drops significantly in the market. These are stocks of companies that have a market capitalization ranging from the $10 to $200 billion bracket, and are defined by their large scale of business, and a significant hold over their total addressable market. As a result, their financials tend to be stable, and more often than not, they reward shareholders with a handsome dividend amount. While it is true that large cap companies seldom take on an explosive growth climb, as their much smaller peers do, given a less prominent growth runway, these stocks offer significant stability to one's investment portfolio. This is especially true given the low volatility associated with these names, thus making them prime candidates to ensure risk diversification. Given the present climate of uncertainty and wider bearish sentiment, these stocks with reliable profit streams are ideal to consider investing in. In this video, we present the best large cap stocks to invest in before 2023 that will deliver the aforementioned benefits to one's portfolio. The first stock we present is one of the top sports lifestyle players, Adidas AG, which trades in the OTC as ADDYY. Adidas is the second largest sports apparel brand, after Nike, while holding a top leadership position in the European market. The company has seen its business impacted significantly since the economic pressures of COVID-19 and present complications in both Europe and China. The stock has seen a 62% fall in the last 12 months, which makes its valuation extremely attractive in the present moment. For instance, its dividend yield at over 2.74% is higher than the sector average yield of 2.4%. Secondly, even the most conservative of analyst projections indicate significant growth based on fundamental performance, which could see an ADDYY price surge of 44% in the next 12 months. This positive growth outlook comes primarily as a result of positive performance in the North American and Latin American markets, which saw 21% and 37% year-on-year growth in the company's most recent quarter. Similarly, the COVID-stricken paralysis that was spread through the Asia-Pacific market now also seems to have come to an end, with Adidas revenues up 3% year-on-year in these markets. This growth recovery, despite macroeconomic conditions, has been linked to product innovation in football, running and outdoor gear. Moreover, a renewed emphasis on e-commerce channels has also proven to be a core growth driver for the company. Given these fundamental and business conditions, ADDYY is likely to take off at full throttle by 2023. The stock therefore is a screaming buy. The second stock on the list we present is the renowned social media platform, Twitter Incorporated, which trades by the ticker TWTR. The company describes itself as being a public platform of self-expression for conversation in real time. Although the company has been at the forefront of the social media game throughout the last decade, recent events have brought it into the global spotlight. Following the interest of billionaire Elon Musk in acquiring the company, the investment potential of Twitter has been widely discussed. The company saw a surge in new users in the lockdowns during COVID-19, pushing up growth to a record high of 34%. This is presently down at 10%, yet revenue per monetizable user continues to grow in an upward fashion. Twitter recently shifted to a general manager model, which the company's board has emphasized would be far more appropriate in following a value-enhancing strategy. This would allow for the launch of new products and features, each of which are set to collectively expand revenue from monetizable daily active users. Similarly, Twitter in recent years has shifted onto a more revenue-centered business strategy, after being criticized for not operating as a company that accommodates the interests of its shareholders. As a result, the year-end of 2021 saw revenue climb annually by 37% to $24.17 billion. This large cap stock is on its way to accelerate its rise to the top, and would be a great pick to buy before 2023. Before we move on to the next stock, we'd like you to know that we offer a morning newsletter to our email subscribers. Prior to the market opening, we send our subscribers an informative email about which stocks are moving or about to move. You will get an overview of key earnings reports, recent insider transactions, analyst upgrades, and downgrades. To take advantage of this offer, you can find the link in the description box. If you're still with us, it means you've liked our video. Do click on the like button to show your support. Number 3 on our list of top large cap stocks is the healthcare giant, Abbott Laboratories, which trades by ABT. Since the start of 2022, ABT price has dropped by almost 28%, presently making it a dividend aristocrat. This is because of its 1.87% forward dividend yield, which is considerably higher than the average in the healthcare sector. In the last 3 years, ABT saw its dividend payments grow by 14.5%, compared to the healthcare sector's average of 6.7%. During the COVID-19 phenomenon, Abbott experienced booming business performance, particularly in terms of its diagnostics segment. Even 2.5 years after the outbreak of the pandemic, demand for these offerings remains highly significant, and is proving to be a major growth driver for the company. The company's EPS in its most recent quarterly release climbed from 67 cents to $1.16 on a year-on-year basis, which reflects a staggering 72% climb. Given the stellar business performance across all the company's business segments, Abbott has upped its annual EPS guidance to $4.90 at the end of 2022. Healthcare in particular is a highly resilient economic sector, given that demand for its products remains indifferent to macroeconomic circumstances. Abbott Laboratories stands well positioned to climb high off this advantage, and is on its way to attaining soaring highs. Next up, we take a look at the world's famous specialty coffee maker, Starbucks Corporation, which trades under the ticker SBUX. Starbucks has established brand loyalty over the decades that is hardly paralleled by any other company. From a fundamental standpoint, this gives it incredible competitive edge, especially during economic stresses such as in a recession. Because of this, the company has been performing incredibly, even during the inflationary pressures of 2022, which has had many global industries report a slowdown. In its most recent quarter, the company saw its quarterly revenue climb from $7 billion to $7.6 billion on a year-on-year basis. Its EPS is estimated to rise by 15.5% and 17.6% for 2023 and 2024 respectively, given the high rising demand for its products. In addition to such strong fundamental growth, Starbucks is also an extremely shareholder-friendly stock. For one, the stock has been consistently paying out and increasing its dividends without fail for the last 11 years. The dividend yield presently stands at 2.33%, which is extremely attractive. In addition to such strong dividends, shareholders have something else to look forward to. Starbucks is also known for returning value to its shareholders through periodic share buybacks. In the last 10 years, the company's outstanding shares have been cut down by more than a fifth of their total. In the longer run, this could prove highly advantageous for investors, allowing their capital to appreciate significantly. With so much going for it, SBUX is not a stock to miss out on, and is definitely a buy before 2023. The final stock on our list of top-tier large-cap stocks is Walmart Incorporated, the giant American retailer and wholesaler, which trades with the ticker WMT. Given its price tumble in July, WMT stock is down approximately 10% since the start of the year. Giant players like Walmart, that have an established dominance within their market, are matured companies that do not typically see high-paced growth. Walmart, however, has proven otherwise, as per its July 2022 quarterly release. The company has delivered top and bottom line growth of 8.4% and 23.2% respectively, on a year-on-year basis. What was most remarkable during the quarter was Walmart's e-commerce sales growth, which stood at 12%, indicating Walmart's commitment to transforming its business in light of the present market realities. Walmart achieved such stellar performance metrics despite the prevalent macroeconomic headwinds, while operating in an industry that takes a hard hit during periods of inflations or recessions. Management achieved this feat through an aggressive markdown on inventory. Moreover, in these tough conditions, the retail giant also handsomely rewarded its shareholders, with $5.7 billion in share buybacks, and $3.1 billion in dividends. The company's annual dividend payout is presently at $2.24 per share, which translates to a yield of 1.75%. Walmart's dividend is one of the most attractive, especially considering that the company has a consistent, 48-year history of growing dividend payments for shareholders. In terms of reliability and stability, few stocks are as good as Walmart, which is a must-buy for anyone looking to diversify against the volatilities of the market before 2023. That's all from us in this video. We hope the insight we aimed to deliver has proven valuable to you, and would allow you to ensure your portfolio is well exposed to strong and secure large-cap stocks. We would love to hear your feedback about our list in the comments below. To gain a deeper insight into different stocks that are fit for various investment strategies, be sure to check out our website, stockstelegraph.com.